For those of you who have just joined, we'll begin the webinar in just a few minutes. Right now, people are trying to enter into the webinar, so we'll wait until everyone gets in, and then we will begin. Okay, it looks like everyone is in from the waiting room. There'll be more, of course, joining us later, but why don't we start? Welcome to our 2020 joint UCLA Anderson Forecast, UC Hastings College of Law Conference on the Economy and Law. I'm Jerry Nickelsburg. I'm director of the UCLA Anderson Forecast. And joining me is Jared Elias, who is a professor of law at UC Hastings College of Law. And this is our third or fourth joint conference.
Fourth, I think. Yeah, fourth.
It's the fourth. So the fourth annual joint conference. And of course, it's 2020. So we're bringing you this conference virtually. But as you can see from my background, I'm here on a sunny day in San Francisco. I know it's partly cloudy today, but I'm bringing you sun in San Francisco. Needless to say, this is an uncertain time. At least some of the uncertainty was resolved this past weekend, but there's much that remains. In this webinar, our goal is to delve into some of these topics and provide a roadmap of how to understand the potential deviations from the forecast outlook, particularly as it impacts California and the Bay Area as this uncertainty resolves itself. And, you know, normally we're in San Francisco on the campus of UC Hastings. We are very hopeful that we will be there next year, but this year we are virtual. So before we begin, let me go and share some slides, and we'll go through the agenda for the morning. And here it is, and I'm going to go to slideshow. Okay, so here's where we are in the 8:30 to 8:35 time frame with welcome and introductions. Then I'm going to begin with the economic outlook for the nation. That will be followed by Dr. Laila Bengali, who's an economist with UCLA Anderson, on the economic outlook for California and the Bay Area. We'll have some time for Q&A after that. Please use Slido for your Q&A, and I believe in the chat room that is all set up for you. Slido is really easy to download. If you don't have it, just download the app, put in the Slido number, and you'll be in and ready to ask questions or to vote on questions that have been asked by others. So that will take us up through about 9:25. And then the balance of our conference, we're going to turn to something that's increasingly important as we move out of this COVID-19 induced recession. And that's the subject of bankruptcy in general and here in California. We're seeing, you know, there were announcements today of 2 malls that have now filed for Chapter 11 protection. and this is only going to increase. So Jared has assembled a really outstanding panel. He will introduce the panel when we get to the panel, but that's going to be a really informative and fascinating panel, so stay tuned. And then we'll wrap it up at 10:30. Before we go into the economic outlook, I do want to take a few moments to thank our sponsors. Both UC Hastings and UCLA are public institutions, as you know, and it would not be possible to bring you these programs and to do the research that we do without the generous support of our sponsors. And so we're most grateful to them. Our principal sponsor is RSM. They're a long-term sponsor of the forecast. And we are thankful to RSM. Our platinum sponsor is University Credit Union that started on the campus of UCLA, but is now expanded to cover campuses fairly widely. And our gold sponsor is United Airlines, and we welcome United Airlines to our conference and thank them for their sponsorship. Our silver sponsors are California Bank and Trust, VACO, Warland Investments, Kenneth Broad, and Chip Robertson. Many thanks to our silver sponsors. Again, we would not be able to bring you these programs without their generous contributions, and we are most appreciative. So with that, let's turn to the U.S. outlook.
Jerry, before you get too much further, I just wanted to let you know that we can't see your slides.
You cannot see my slides. Oh, no. Thank you, Lila. So sorry about that. This is technology in the age of COVID. Let's try again. Can you see them now?
Yes.
Okay. We're going to just back up a minute and okay, here's the agenda. You should have that agenda in your email with the other materials. This is our sponsor board. And again, RSM, University Credit Union, United Airlines, California Bank and Trust, VACO, Warland Investments, Kenneth Broad, and Chip Robertson. Many thanks to our sponsors. And now, Lila, can everyone see the slides?
Yes, I can see your slides.
Great. Okay, so the real story now when it comes to the economic outlook is, of course, the pandemic. And I just wanted to start off with a baseball picture. I know baseball season is now ended. But what you see here on the left-hand side is a picture from 1918. And in 1918 we had the last major pandemic in the United States. It was the influenza pandemic. And what happened in baseball was that many baseball players became sick with influenza, and baseball teams were calling up promising young players from the minor leagues. The Boston Red Sox called up a promising young pitcher who led them to the World Series. He won the first and fourth games of the World Series. He was also a renowned slugger. And of course, that's Babe Ruth, who Boston, for reasons still unknown to this day, traded him after the season. But what's important here for us is that Boston, in celebration of their success in baseball, opened up early, as did Philadelphia for other reasons. And they had parades and they were very happy about winning the World Series, but they had worse economic outcomes and worse health outcomes than other cities such as St. Louis that stayed on lockdown or partial lockdown longer. Now, it's only one data point, but it does inform us that the course of this pandemic and the public health response to the pandemic are really important in what happens in the evolution of the economy in the coming years. And much of that is unknown. So in order to do a forecast, we have to make some assumptions. And our critical assumptions in the forecast that you'll see, but I'll talk about these a little more as we go along, are that the pandemic in 2021 and 2022 has a moderate to low impact on the economy. Now, that was looking 3 weeks ago like a heroic assumption. It's looking more plausible today, but still we don't know. It is an assumption, not a forecast. The second is that a stimulus package from Washington would occur in the fourth quarter of this year. That may still happen, but if a stimulus package does occur, we won't see that hitting the economy until early in 2021. And we don't know who's going to be controlling the Senate. So we actually have no idea as to what stimulus package might come about, if any. So that's our assumption. And that means that we have a stronger fourth quarter of 2020 than we might otherwise have. And then the third is that near-term economic policy, including taxes and spending, is not radically changed after the election. I should change this to say after the inauguration. That's typical, and particularly if we have a divided Congress, don't expect a lot of major changes to happen in macroeconomic policy that would affect the trajectory of the economy, at least in 2021. So with that, let's dive into the numbers. These are the GDP numbers, and you see increases in 2018 and 2019. In 2020, we dropped by 5%, and then we have the huge drop in the second quarter over on the right-hand side in GDP. We get a rebound of 33 plus percent, 33.1% in the fourth quarter. And that's kind of an astronomical growth, but that's really a function of the economy opening up, of businesses that were closed being allowed to open, rather than very strong underlying organic growth. And where that leaves us is 3.5% below the peak, similar to where we were below the previous peak in the 2008-2009 recession, the Great Recession. So we are as in the same hole that we were in the depths of the Great Recession, not out of the woods yet. So how do we know what comes next? Well, this is a recession that was induced by a pandemic, was induced by people either being mandated or unwilling to go and purchase services that are human contact services. And we look back to say, well, when was it that people were kind of afraid to purchase services? And one of the instances that I'd like to share with you is this. This is monthly domestic airline traffic. It's revenue passenger miles. One person flying 1 mile in a seat that they paid for. And the data is from 2000 to 2004. And it goes, along at about 60 billion revenue passenger miles. In March of 2001, we began a mild recession. For those of you who are viewing from San Francisco, you didn't think of this as a mild recession, but nationwide it was. And then we get to the horrific attacks on 9/11, and you see a very sharp downturn. And the airline, US domestic airline system was shut down for a couple of days, and then TSA began to be ramped up along with air marshals and reinforced cockpit doors. That took a couple of months. And that pattern there looks a lot like the pattern that you just saw with GDP. And thereafter, you get sort of a very gradual increase in demand as people move from not wanting to fly to realizing that it's safe and then going back to flying. Kind of similar to the two pictures on the left, which were taken on Labor Day of this year, of those who have a high tolerance for risk. That's at Redondo Beach in Southern California, and those who have much less tolerance for risk. And that's in the Sespe Wilderness in Ventura County. So that informs us about what's going to happen with consumption. And we have a very similar pattern with consumption. It's going to be less than this for quarter four because of the stimulus package being moved out into 2021, but very slow growth as you come out, and we don't really get back to the previous peak, much less any growth from the previous peak, until we're into 2022. That scale on the left is a percentage of the peak. So you see it hits 1 at the peak and then comes back to 1 in the first quarter of 2022. Consumption 70% of GDP, so this is going to have a huge influence on our GDP forecast. And you can see that right here. It's a similar pattern. It's a little more rapid growth because of that other 30%, which is comprised of government, net exports, and investment. Now, net exports are not going to add much of anything because, as you know, not only is the United States in a COVID-19 induced recession, but so is the rest of the world. And so we have this growth, and this growth takes us back to actually a little bit above our previous peak in the fourth quarter of 2019 by the time we get to the end of 2021 and entering 2022. So that sounds good, except for that 2018 and 2019 period. It's a time of 2.4% growth in GDP. And if you just draw a straight line through it, what you see is we're way below that, and we're below that going into 2023. So we're a long ways from catching up to our trend and making up for this recession. One of the things that bothers us is this initial claim for unemployment insurance. It's a measure of layoffs. It's stayed persistently high. It dropped again, but it's in this last week, but it's in the 700,000 range. And that is 100,000 initial claims higher than the highest weekly claims in the depths of the Great Recession. We think this is going to come down rapidly over the next month or two, but it is worrisome that there are still problems in labor markets. Turning now to financial markets, the Fed rolled out a new interest rate policy, and this is Chairman Powell explaining it. And basically the new interest rate policy is that the Fed is going to pay attention to unemployment, and not just the aggregate unemployment rate, but unemployment by type of person unemployed. And they are going to no longer be looking at the inflation rate until they see that the inflation rate is substantially above 2% for a significant amount of time. Who knows what those words mean? But the outcome of this is that we're in for a long period of very low interest rates. And that's good for investment, both personal investment in homes and business investment. And that gives us our real non-residential fixed investment forecast. Now, part of non-residential fixed investment is oil drilling rigs. So that's kind of holding that back with the low price of oil. But we get a sharp snapback, and then we get to an average of about 5%. Those low interest rates will cause more investment than we saw leading up to the recession, but not a lot more. Lending standards have certainly increased on the part of lenders, of banks, in the face of this additional uncertainty. But on the housing side, and this is National Association of Realtors data, what we see is home sales have soared to higher than they've been in recent times. And home prices have not fallen. So this is really different in this recession. Usually the housing market tanks in recessions, and now it's with low interest rates and with the burden of unemployment being disproportionately lower income Americans, what we have is higher income Americans with low interest rates and an ability to move to single family homes are demanding them, and sales are at a record level. Prices are holding up, and that leads to more home construction. Now, we think this doesn't have as much legs as maybe other folks do. It's going to end up in our forecast at 1.3 million, which is higher than recently. But some of what's happening is a movement to the suburbs by millennials who are planning on going in a year or two or three in order to have more space to start families, are taking advantage of low interest rates and moving out now because the amenities that they were formerly enjoying in the city core are all closed up. So we've got an increase, but then housing's not going to be driving a rapid recovery. So that's the investment picture. The rest of that 30% of GDP is government. The federal government deficits remain above 1 trillion per year. And we see goods and services purchased by the government growing only modestly and transfers declining very sharply, even if the results of the Georgia election mean that the Senate is controlled by the Democrats. Don't expect a lot out of fiscal policy. Basically, all of the fiscal policy bullets have been fired. And state and local governments are in contraction now in the 2020-2021 fiscal year, and they are going to continue that into the next year. So what that brings us to is we have broken employment relations. That's what happens in a recession. They take time to heal. It's not immediate. It's not like throwing a light switch back on. The Fed's new policy has low rates for the foreseeable future, which makes housing a bright spot, although not a driver of the GDP growth, and fiscal policy is going to be limited. So that's a brief overview of the US forecast. And with that, I'm going to stop share and turn it over to Lila, who's going to talk about California and the Bay Area. Lila, over to you.
Excellent. Thank you, Jerry. And I'm pulling up my slides here. 1 second. Okay, just making sure everyone can see my slides. Please speak up if you can't.
Yes, can see the slides.
Perfect. All right. So like Jerry said, I'm going to talk to you today about California and the Bay Area. So we're going to zoom in a little bit from the US and a roadmap for what we're going to discuss today. So first, I will start by reviewing some indicators of economic activity in the Bay Area and in California. For the purposes of this presentation, the Bay Area is going to be the 7 Bay Area counties, so Alameda, Contra Costa, Marin, San Francisco, San Mateo, Santa Clara, and San Benito counties. The indicators I'm going to focus on are the labor market, then I'm going to talk about personal income and also real estate, and then I'll get to the outlook for the state and the Bay Area. So let's jump in and start with California. So over a longer time frame, patterns in payroll jobs, that's what you're seeing here, in California follow patterns in the US. So California is in yellow and the US is in blue. If we narrow our focus to February to March of this year, California also looks similar to the US. So what this chart is showing you is the percent change in payroll employment or payroll jobs from February to April. So for example, this chart is showing you that from February to April, payroll jobs in the US and in California fell by about 15%. That's this leftmost set of bars here. This chart also shows a couple of other industries, some of the industries that were harder hit, like leisure and hospitality, other services, and healthcare and social services. But the main message is that during the downturn, February to April, California looks a lot like the US, but the similarity starts to break down a little bit once the labor market conditions start to improve. So that's what you're seeing here. This chart basically takes that leftmost bar that you saw in the previous chart and rolls it forward in time, making it into a time series. So that each point is the percent change in payroll jobs since February of 2020. So February of 2020 is 0. You can see the point in April that shows about 15% decline. That's that same bar, same figure in a different form that you saw in the previous chart. And what this chart is showing you is that while California and the US experienced a similar decline in terms of the percent of payroll jobs lost, that California looks to be recovering a little bit more slowly than the US overall. And you can see the same type of picture whether you look at unemployment rates or household employment, which is a slightly different measure of how many people are employed. That pattern is basically that California fell to a similar extent or experienced a decline that's similar in magnitude to that experienced in the US overall, but the recovery in the state seems to be a little bit more slow. You can also see this comparison at one point in time looking across states, and that's what this picture shows you here. This is a map that shows the unemployment rate in September for all of the states in the US, and the darker red colors indicate higher unemployment rates. So for example, the unemployment rate in California in September was 11%. Two states were higher than this, one, Nevada, with about 12.6% unemployment, and Hawaii, where the unemployment rate was just about 15%. So keeping with this same theme of a similar decline in California and in the US, but a slower recovery in California, this chart is showing you the percent change in the number of small businesses that are open. Now, this is a new economic indicator. It's not put out by the government. It's put out by a nonprofit called Opportunity Insights, and it's from their economic tracker. And what this nonprofit does is to partner academics with private companies to provide aggregated statistics from private companies available for the public. So this particular private company is a credit card processor for small businesses. So using aggregations of those credit card transactions, we can get a sense of how many small businesses are likely to be open. So it's not perfect measure, it's not official government measure, but it does provide an interesting window into what's going on in the economy. So here again, we can see that the decline in the percent of small businesses relative to January of this year that were open is similar in the US and in California, but the recovery has been a little bit faster in the US than in California. So in California, there are still almost 30% of small businesses, according to this metric, that haven't opened up again. In the US, that number is a little bit smaller. So let's switch gears a little bit. There have been big changes in employment and labor markets. There have also been big changes in personal income. And I want to take a moment to explain what might initially seem like a confusing pattern. This bar chart shows you the percent change in personal income from Q1 to Q2 of this year. That's this set of bars circled in red. So personal income from Q1 to Q2 went up by 6 to 7% in the US and in California. And this is a pretty big quarter-to-quarter percent change. Typical quarter-to-quarter percent changes are in the 1 to 2% neighborhood in the recent past. And you might expect that personal income would go down in a recession, not up, and certainly not up more than usual. So what's going on? To understand what's going on, we have to look at the components. Personal income is comprised of a number of different pieces. One of those pieces is essentially wages and salaries, sort of earnings at your place of work. Another piece is dividends, interest, and rent. And a third piece is transfers, or third piece comes from transfers from the government. So the question is, how much of this 6 to 7% change is attributable to each of these major components? So let's look at that now. Earnings, so think of this as wages and salaries dropped, which sort of fits with being in a recession. Dividends, interest, and rent earnings also dropped, but just a little bit. And transfers from the government are way up. So these are things like the PPP loans, like the stimulus checks, and like the unemployment insurance increases. So essentially, what seems perhaps like a little bit confusing increase in personal income is largely driven by the large increase in transfers from the government between Q1 and Q2 of this year. So while personal income in Q2 was strong and mostly propped up by government transfers, housing markets were also strong, but more from the interaction of supply and demand. So what do I mean by this? Supply of houses can't change as quickly, it can't change very quickly. And it does seem like a lot of indicators are pointing to an increased demand for single family homes. So that's what you can see here. This shows you a relatively long time series of the sales of existing single family homes. This is one series where you do see a pretty remarkable V. The sales of single family homes are now back above their pre-pandemic levels. And this is consistent with the story of people deciding to leave cities for suburbs, or to take advantage of the low interest rates for those who are able to buy homes to go ahead and maybe shift their decision forward in time to move out of an apartment, so to move from being a renter to a homeowner. So that was California. Now let's talk about some indicators in the Bay Area. I'm going to start with a chart that's very similar to one that I showed you before. This is actually almost the same chart you've seen before, with total payroll employment as a percent relative to February of 2020. But in addition to the US in dark blue and California in yellow, I have added the Bay Area in light blue. And what you can see here is, just like with California, the decline from February to April was very similar in the Bay Area as it was in the US. But like California, the Bay Area has been a little bit more slow to recover. So why is the Bay Area maybe a little bit slower than California overall? One possibility is that people who used to work in the Bay Area are living and working elsewhere. Now, I do want to say that it's not clear to me from reading the technical documentation for the survey that the government survey that creates these data, whether or how remote employees who are sort of temporarily working remotely are supposed to or are being counted in this survey. So the guess or the statement that it's perhaps people who used to be working in the Bay Area but are now living and working elsewhere, causing this difference between California and the Bay Area, is a conjecture. I would have to get someone from the Bureau of Labor Statistics on the phone to really understand, how companies are supposed to versus how companies are reporting remote workers. So this adds a little bit more detail. The Bay Area is not a monolith. There's definitely variation across metro areas, and that's what this chart is aiming to highlight. So the black line is the Bay Area overall. It's the same one from the previous chart, but now I've added the 4 metro areas. You can see that the San Jose, Sunnyvale, Santa Clara metro area was hit a little bit less hard and is doing a little bit better than other metro areas in the US, other metro areas in the Bay Area, like those in the East Bay and in San Francisco. You can also see variation across the Bay Area counties in another indicator of labor market activity, and that's unemployment insurance claimants. So this chart shows you the fraction of the fraction of the labor force in each Bay Area county that claimed some kind of unemployment insurance in August of 2020. So these are claimants, so these are people, counts of people, unlike the claims data that are in the Thursday reports that come out from the Bureau of Labor Statistics, which counts the number of claims filed. So this is perhaps a little bit cleaner of a measure of how many people are actually filing for unemployment insurance in the state. So you can see there is some variation with North Bay and Peninsula counties doing a little bit better in terms of the number of people claiming unemployment insurance, and counties in the East Bay and in San Francisco doing a little bit worse. Going back to a chart we saw earlier, but adding in some more detailed information about the Bay Area, this again shows you Opportunity Insights Economic Tracker measure of the percent change in the number of small businesses that are open. I've included the US, but also 3 Bay Area metro areas. And you can see, just like with California, these there are fewer small businesses, so there's less of a recovery in the number of small businesses that are open in the Bay Area, but you can also see that there's some variation. San Francisco, for example, seems to be doing a little bit worse than Oakland and San Jose metro areas. Now I want to switch gears a little bit and talk about a potential upside for the Bay Area, and that is personal income. The Bay Area tends to have higher incomes than the state overall. That's what you're seeing here. These figures are annual per capita personal income from 2018 for California on the far left, for the Bay Area overall, second from that, and then broken down by the Bay Area counties that I mentioned. So what I want you to take away from this is that incomes, per capita incomes in the Bay Area are higher than per capita incomes in California overall, and that there is substantial variation within the Bay Area with the North Bay and San Francisco and the Peninsula with higher per capita personal incomes, and some of the East Bay and San Benito counties with lower per capita personal incomes. So now I want to connect this to the industry mix in the Bay Area. You can see the higher incomes reflected in the distribution of employment. This plot shows you employment by industry in 2019, but not the level of employment. Instead, each bar is the industry's fraction of total employment. So for example, in the Bay Area, about 20% of jobs are in the professional and business services industry. And if you summed up the height of all the blue bars, you would get to 1. So that you'd account for 100% of the employment in the Bay Area. And similarly, if you summed up the height of all the yellow bars for California, you would also get to 1. So I'm showing you this chart to make a point about incomes in the Bay Area versus California, and to show you that the Bay Area has proportionally more jobs in high income sectors. So if you look at data from a survey called the Quarterly Census of Employment and Wages, and you look at the average annual earnings in different industries, you see that certain industries like professional and business services, and let's see, one second, professional and business services, manufacturing, financial activities and information tend to be those industries that have higher average annual incomes. And in all of these, the Bay Area has proportionally more employees in these industries than is the case in California overall. If you look at the lowest earning sectors, like leisure and hospitality, other services, and education and health services, the Bay Area tends to have fewer of these, fewer employees proportionally in these sectors than California overall, which supports the idea that the Bay Area has, or which sort of supports the observation that the Bay Area tends to have higher incomes. So I want to make a quick comment about housing markets. Like in California, housing markets in the Bay Area have been strong. If you were expecting that a lot of people are leaving the Bay Area, permanently or temporarily, you'd expect to see that list prices and sale prices would start to fall. Maybe there's a little bit of flattening off, but we don't see dramatic declines. You'd also expect to see longer times of properties being on the market, and that's not shown in this chart, but you, at least according to the data that Zillow puts out, you don't see that. What we do see is that rents are falling. There have been a lot of reports about double-digit rent drops. The reason you're not seeing double-digit percent drops in rent here, San Jose about 4%, San Francisco about 6%, is that These are metro areas. So the San Francisco metro area is going to include the city, but also suburban areas, same with San Jose. And also this rent index published by Zillow covers all homes, not just apartments. But still, you do see a notable drop in rents. And this is consistent with one story, which is that renters are switching to being homeowners. It's also possible that people are leaving the area. And I think an open question that I don't know the answer to is how many of these departures are permanent versus temporary. And that's something we'll sort of have to wait and see to find out. So now I want to move on and talk about the outlook for California and focus on a couple of key indicators. So this is our forecast from September. And to give you a sense of scale and time frame, I'm showing you Q1 of 2020 all the way through the end of our forecast horizon. If you focus on the blue bars first, these are payroll employment forecasts. Payroll employment was just over 17.5 million individuals, or 17.5 million jobs at the end of 2019. And our forecast is for payroll employment to get about 97% of the way back to that figure by the end of 2022. The yellow line is the unemployment rate, and we project that that will follow roughly the pattern of in the US, but will be higher than the US unemployment rate, ending 2022 just under 6%. So as with the forecast that Jerry gave, these forecasts rely on several assumptions. One is that the pandemic will have a limited economic effect in 2021, and also that there would be a stimulus package in Q4 of this year, which is, my personal feeling, is less likely to happen, or at least the effects of the stimulus package are less likely to hit in the Q4 of this year. So I think now I'll go on to the Bay Area and our outlook for the Bay Area. This is showing you what we're projecting for payroll employment, and the figures are showing you percent change from the prior year. So as I mentioned, the Bay Area has more tech and more high income employment, also more jobs that can be done remotely than California overall. So in the Bay Area, we're expecting a better 2020 and also a stronger 2021 in terms of payroll employment. Looking at real personal income, I showed you some charts on personal income before. We're projecting that 2020 will be better in the Bay Area than in California because the Bay Area has more high income earners. Also, personal income includes interest, dividends, and rent, and asset markets have generally held steady. So we're also projecting less of a drop off in 2021 for the Bay Area relative to California. So the overall theme is that we are projecting the Bay Area will be hit less hard than the state overall by this recession because of the Bay Area's higher income, greater ability for remote work, and to some extent, the status of the coronavirus in the Bay Area in the near term. So that's what I have for the Bay Area and California, and I will turn things back over to Jerry.
Great, thank you, Lila. So now we have a little time for questions. We have some questions that have come in on Slido, and let's start with this. So it's, as transfers come to an end, what do we expect to happen to income? Have earnings and wages recovered, or do we expect a big drop in income? So the personal income data that Lila showed you, Lila, that includes transfers, right?
Yeah, so there was a chart that had on the right side personal income. That was the total percent change in personal income, and then the three pieces towards the left, those were the components, and that was Q1 to Q2 for California and the US. The reason I had that is that we don't have Q3 for California. We do have it for the US, and if you look just at the US, so we don't have the official numbers for California, but if you look at the US, between Q2 and Q3, you actually see a decline. So the overall headline number for personal income has gone down. Why is that? actually earnings, so basically wages and salaries, that went up a little bit, but transfers basically not completely disappeared, but they fell off dramatically. So even though quarter 2 to quarter 3 wages and salaries went up, which is sort of consistent with the beginning of a recovery, overall headline personal income went down in the US quarter 2 to quarter 3 because transfers went away, or didn't go away, but they fell off dramatically. I hope that answered the question.
Yeah, so earnings and wages have not recovered because we have very high unemployment still. And we expect, as these stimulus programs end, and they've been ending kind of continuously through the third quarter and now the fourth quarter, that part of personal income, those transfers, will continue to decline and won't increase again until and unless there's another stimulus package. Okay, so the next question, what does the change in home prices versus rents, so Lila, I think this is for you, suggest about demographics? For example, older homeowners remaining, but younger renters leaving the Bay Area. What are your thoughts on that? I have some thoughts on rents also. I don't know if we agree, but why don't you start out?
Well, so in terms of rent, and this gets back to, I guess, more anecdotal evidence. So maybe I should step back and say, I think one of the ultimate questions here is how many people are, or how many people will permanently leave the Bay Area, and who will those leavers be if in fact there are people who permanently leave. Unfortunately, there are essentially no quickly available official statistics that I know of, and that people who are studying this area know of, that would capture how many people are leaving the Bay Area. So are leaving any particular area. Statistics on migration are, I mean, they're available, but generally with a substantial enough lag that it won't be helpful in answering, the questions about what's going on now, what's going on in the last month, or even 3 to 4 months. Anecdotally, I know of a lot of people who, the younger individuals who would have been renting, who've decided to let go of their rent, move back with family, move to a different location, since they are, or I should say, if they are able to work remotely. But all of these people, and again, this is anecdotal, all of these people I know of are, have kept their California-based job, are planning to come back when they're able to go in person to the office. So while this is a question initially about rents and renters and homeowners and demographics, I think it's also important to note that we don't know how much of what's going on will be permanent versus temporary. If it's sort of a temporary thing, then the long-term effects on this, there might be fewer long-term effects on the state. But if temporary becomes permanent, if a lot of individuals who were renters, who maybe tend to be younger, tend to be starting their career, move to different states, then that's something we'd have to consider for demographics going forward in California.
Yeah, so I think you're right. We don't have a lot of data on California, but what we know about New York City, I think, is instructive. So there were many people in New York City who lived outside the city but maintained an apartment in the city, and they'd come in and work long hours and go to their apartment to sleep during the work week, or at least during part of the work week. Well, they don't need that apartment anymore, so they've been giving that up. And then another element affecting rents are students. So students aren't coming to campus. Unfortunately, we'd love to have our students back on campus, but they're not. So they're not renting apartments in the Westwood area. They're not renting apartments in San Francisco and other parts. So that is another element in the demand that has shrunk for city centers. So I think that's instructive. But I think one thing to consider, and this goes to another couple of questions that we have, is that you maybe can live in Idaho and work remotely, which Lila did for 2 months.
Maybe a little longer.
Maybe a little longer. You can do that, but if you are early career, you need to network and you need to be connected to others in your profession. That's just part of your professional growth, and it's very hard to do if you're scattered all over the country in remote locations. And and there's also the social aspect. So expect creative young people to be coming back to San Francisco, and that this is a temporary kind of phenomenon. So I think the demographics favor an influx, again, of millennials into the city, with the exception of those millennials who have now reached the age where there's some interest in childbearing, in which case you are going to see migration to the suburbs. And so we have lots of anecdotes about that, not a lot of data. We've got a couple of other questions here about construction, so let me try and get to those in our time remaining. The first is from Pat. Are there any indicators of investment in infrastructure, roads, bridges, water, sewer, et cetera? No new indicators. There has been talk about it. Depending on what happens with the Congress, there may be an infrastructure bill that comes out in 2021. That, if it does happen, will increase construction, but over a fairly long period of time. The infrastructure that started during the Great Recession is still going on. And then the second is with the significant commercial real estate and even residential real estate constructed in San Francisco during the past 2 to 3 years. And now with employment, resident departures, will we see high vacancy rates for years to come? So I think I want to go back to my previous comment that we're really not going to see a lot in the way of resident departures, that we're in an unusual situation where the lockdowns, and certainly you all know that San Francisco has been fairly strict with those, have caused folks to be working away from the city. And this conflates the public health response with the economic response. And there are many reasons why folks need to be back in the city. There are agglomeration effects. There is connection with other firms. There's the social aspects. So we expect there not to be high vacancy rates for years to come. Kind of interesting, there's some tasks that can be outsourced, and they would have been outsourced anyway, and now they are going to be. And those are ones that really don't need to be to be done around other people. They are less creative and more routine. And we will indeed see some of those departures. But one thing that I noticed, and now I forget which company it was, but it's a Bay Area company, has offered to give bonuses to those who choose to move out of the city to more remote locations, and then they can permanently work remotely. And they're doing that because they are also reducing the income of those folks. They're saying, you now live in Ames, Iowa. It's cheaper than San Francisco, so we don't have to pay you as much. So on the one hand, you get to live where you want and work remotely. On the other, you don't really get full advantage of the lower cost of living because your income has gone down, and your both your professional and social connections that existed in San Francisco are now broken. Of course, you can establish new ones, but there are all kinds of costs to moving. So I don't know what the uptake is on that offer, But, when you sort of start to think through it, it's a big deal to move away from the center of activity for your profession. And I think that brings us to the end of our time. So hopefully we've given you an overview. We have upcoming our post-election forecast, which will be released on the 9th of December. But now let me turn it over to Professor Elias and his team of experts, because as we know, bankruptcies tend to be lagging in a recession. And even though the data we showed you indicated that we're coming out of this recession, the bankruptcies are starting to pile up, and there are many interesting questions here. So Jared, over to you.
All right, well, thank you so much. Let me just get my slide shared and then we can get going. Oops. Okay. Oops. All right. Do you see my slides?
Yes.
Yes, we do.
Yes.
Okay. All right. So thank you so much. That was a really wonderful and interesting presentation. I thought I would open with just a little bit on what's going on in the world, and also to introduce our panelists before we get into our discussion. So how exactly are things going in the world of corporate restructuring? Well, if you look at the numbers, just the raw number of Chapter 11 cases that have been filed over the past 5 years, what you see is that we recently, at the beginning of the pandemic, had something of a spike. And then since then, it's come down a little bit. And with the panel, we'll discuss exactly why we saw the spike and why the number of Chapter 11 filings has come down to really early 2019 numbers. To put this recent spike into historical perspective, looking at the past 20 years, if you look at the .com bust over here, you see there's a spike in terms of number. We then get a similar spike in the financial crisis and a similar spike today. And it's really hard to take that much from this comparison, just because firms themselves have changed so much over this 20-year period. The economy has changed in lots and lots of different ways. The way the companies are financed have changed, but it does look like a spike that is similar to what we've seen in the past, but briefer than some of the recessions that we've seen in the past, especially that 2001 .com bust, where we just saw a wave of corporate failures. The Chapter 11s themselves today are also different, right? So even though we're close to a historic peak in terms of the number of bankruptcy filings we recently saw, Chapter 11 cases now are much quicker. So this graph just shows you the number of days to between a company filing for bankruptcy and then leaving bankruptcy over the past 20 years. Right? In 2000, it took about 450 days for a large company to get through the Chapter 11 process. 2005, that was down to about a year. 2010, even less. 2015, 200 or so days. And then that number just kept shrinking over time. So even though we've seen a large number of recent large bankruptcies, the way the process works has changed over the past 20 years, to the point that this recent COVID bankruptcy surge ends up playing out a lot differently through the bankruptcy system. There's possibly more work going on outside of bankruptcy court. And when companies get into bankruptcy court, maybe bankruptcy lawyers are just better at getting these companies through the bankruptcy process. So we have a great panel today that's going to talk about these issues. Our first panelist is Stephen O'Neill. Stephen is a partner at Dorsey & Whitney, based in Palo Alto in Los Angeles, or he was in the pre-COVID times. I don't know where your COVID studio is today. But Stephen also has the perfect set of credentials for this event, with a bachelor's degree from UCLA and a JD from UC Hastings. And he's a partner in Dorsey's Finance and Restructuring Group. And Stephen's been working for over 25 years counseling debtors, creditors, boards, and management in bankruptcy cases, business reorganizations, assignments for the benefit of creditors, and out-of-court workouts. He has represented businesses of all development in a wide range of industries, including energy, technology, transportation, medical devices, clean tech, and food. And importantly, for the purposes of our panel, Steve's practice is really concentrated here in California with a heavy representation of Bay Area clients. Our next panelist is Tanner McDiarmid, who has a bachelor's degree from UCLA and is a partner with Meru in San Francisco. Tanner specializes in providing advisory and interim management services for companies in varying stages of transformation and distress. He works on the ground in the business, and this is something that makes him different than Stephen or our other panelist, Jamila, who I'll tell you about in a second. He's not a lawyer working through the court system. He's working with business people to try to help them navigate the challenges that they faced in stressed situations. He has worked in retail, energy, healthcare, manufacturing, advertising, and many other industries, and his deals have won awards from the Turnaround Management Association. Prior to joining Meru, Tanner worked for Alvarez & Marsal, McKinsey & Company, KPMG in San Francisco, doing restructuring work and audit. And then finally, joining us from the other side of the country, and we're so happy that we're getting this perspective as well, is Jamila Willis, who's a partner with DLA Piper in New York. Jamila has a bachelor's degree from the University of Pennsylvania and a law degree from the University of Virginia. Jamila is a lawyer who specializes in advising distressed companies both in and out of bankruptcy court. She's worked on major bankruptcies both in the US and bankruptcies with global implications, which fits DLA Piper's global platform. Her industry experience includes, among other things, retailers, infrastructure, manufacturing, pharmaceuticals, lots of different places. She also does work for private equity firms and hedge funds looking to make money in distressed firms in special situations. And prior to joining DLA Piper, Jamila was a lawyer at Bryan Cave in New York City. And now I'm going to stop my sharing and we will have a discussion if everything is set up accordingly. Oops. All right, do we need to do anything to change the screen? I don't think so. Okay. So I thought I would start off just by asking each of you to open by discussing sort of where were you when COVID hit and what has your life looked like since then? And Tanner, why don't we start with you?
Yeah, sure. I was actually in Boston when COVID hit. I think I remember tensions were sort of rising that week, and then Trump made his State of the Union speech, and the next thing you know, everything shut down. I was working with a client that was serving schools, and on my plane ride back from Boston, I think everybody at that point was pretty concerned about people coughing on the plane. And I landed to about 60 frantic text messages from my client. So it was a very stressful time. Luckily, we closed around the financing right before COVID hit, so we had a bit of a runway, but many did not.
Stephen?
So I was in Palo Alto. I was 2.5 years ago, my wife and I decided to start splitting our time between Tucson and Los Angeles and Palo Alto. And I was in Palo Alto with my wife working. She also works in the Palo Alto area. And I was interviewing a lateral candidate on March 16th. And I came back to the office and our office manager said, we're closing the office at effective 5 o'clock. You can't come back. And I called my wife and said, let's go to the airport and fly to Tucson. And I've been in Tucson pretty much other than traveling around since then. So my studio is the Tucson studio of Dorsey and Whitney.
Jamila?
Sure. So I was traveling between Wilmington and New York. I was actually working on a prepackaged bankruptcy case for a medical device company that does a lot of their medical devices used in elective surgeries and not necessarily emergency surgeries often. And I came back to New York. I thought I had a full, week or 2 weeks of continuing to traveling for some marketing, traveling for potential other cases. And those quickly came off my calendar as people continue to be more and more concerned with whether or not we should even be traveling to see people or being on planes. And then shortly thereafter, I was told by my office, we're going to be all going to work from home. First, it was voluntary. A day later, it was mandatory. And so I spent all of March and all of April in New York City, which was probably ground zero for COVID at that time.
Yeah. And so, for my part, I was supposed to speak at a bankruptcy lawyer conference in San Diego in late April. And I remember during this period hearing every week from the organizer of that conference, we're still not sure we're going to cancel. We'd really like to keep this thing going if we can. And then, of course, I guess that reality set in. So, so the next question for the panel is, what were you hearing from your clients at the beginning of COVID? And, how is that different from what you're hearing today? And why don't we start with Tanner again?
Sure. I think for me and my clients, March and April were really centered around extending the cash runway in whatever way possible. So frantic cost reductions, furloughing employees, grabbing PPP loans in whatever way possible when those were hitting the market in April and May. It really was just survival up until about June when we got a sort of a breath once PPP had been available. What we're seeing now is mostly
Stephen.
What we're seeing now is mostly, how do we fix our operating model to live in this world of sort of uncertainty? How do we communicate with one another on a more real-time basis than, developing annual budgets or annual operating plans? And so it's really more focused around being flexible in sort of this uncertain world that we live in.
So with my clients, Jared, my typical clients are a venture-backed company that's located in California. And most companies, a lot of them are pre-revenue, and they were just sort of going on, moving forward and trying to raise the funding, your typical venture funding. There was a lot of funding still going on, and I think the venture community is still doing it. But what I did see that there was a lot of my firm's clients, they're traditional, as of, in February, they're robust. All of a sudden, they're in the travel industry or the hotel industry, and they went to shut down. And as like Tanner was saying, they had to furlough immediately into crisis. And I was pleasantly surprised in dealing with a lot of the boards that I came across with, a lot of boards I deal with have young entrepreneurs. These were all very experienced board members, and they were very proactive, and they went to shutdown mode and into a crisis management, and tried to figure out a way to survive, at least for some period. And they didn't know, and they for that time period, they had no idea how long this was going to last. I'm pretty sure they didn't think it was going to, we'd be in shutdown mode this long. But so that's how the clients were really reacting immediately. And of course, all the tech companies in the Bay Area, they all went to remote within 30 days. Everybody went remote.
So for my clients are generally split into two sort of buckets. One, I work a lot with debtors, so you have the companies that are bankrupt themselves. And then I also work a lot with investors, so funds or larger companies that are looking to purchase either businesses or assets out of bankruptcy. And so for the first bucket, the debtors, it was a really scary time. You probably remember at the beginning of the pandemic, there were all these rumors circulating about what a shutdown might look like, and New York might shut down the subway system. And so they didn't really know what it was. And when you're a debtor and every single day you're looking at your cash position and how long you can last to get to a filing. I mean, we went to thinking, okay, we have 6 weeks to a filing, to we might have a week to a filing. So we're going to need to make sure we're prepared and sort of have documents, the petition, the motions, et cetera, just ready in case we need to do a crash filing because we can't get through the next 6 weeks. I'm happy to say that that was not the case. I think that even with the shutdowns, they were a little bit more, they weren't as, I think, aggressive as we anticipated that they might be. And with respect to my other clients who often invest in distressed assets or distressed businesses, they were looking at it as an opportunity, really. So a lot of them reached out to me and said, we have dry powder. We just want you to know if there's anything out there that we might be interested in, here are the industries we're looking to invest in, then please let us know immediately. Now it's a little bit different. I think that in terms of the funds and investors, it's still the same position. They're looking for opportunities still. For the debtors, I think that things are a little bit calmer, thank God. They're being a little bit more, I guess I would say that with respect to what they see in their cash position, there's not like the initial panic that there was back in March and April.
Great. And so that brings us to another question that I think is really important for fleshing out what's going on in the market today. So one of the things that I noticed both on the policy front, from the government and, from, people working in industry and people in the restructuring community is there was this immediate sense that we needed to sort of go back to that 2008 playbook and pull back out all the things that we used to have in 2008. And I think we saw this most strikingly from the Federal Reserve, where all of a sudden, in a day, we brought back online all of these crisis programs that were built to deal with the credit crunch. But as Stephen and Jamila have already hinted, this is a very different financial environment in a lot of ways. Stephen mentioned that there still seems to be venture capital out there. That was a little bit less true in 2008. Jamila's talked about the fundraising environment and the sort of the excitement on the part of distressed investors to grab a hold of this once in a generation, credit dislocation event, as they would euphemistically call it in the industry. Jerry and Lila might call it, people losing their jobs, but this is this is just the way that people talk. And so the question that I want to pose to the panel is, what has been different to you, seeing what's happening now versus, your experience or what you remember from the 2008, 2009, 2010 recession? We'll start with Jamila this time.
Sure. So back in 2008 and 2009, there were a lot more free fall bankruptcies. I think that the fundamental difference then is, even though the cause of the 2008 recession lasted for a very long time, I think that when to a layperson, there were one thing, that the housing market crashed, Lehman filed for bankruptcy, and then the recession came out of that. I mean, now I think you can look back and you say, no, there were many causes that lasted over a period of time. COVID is really different because we're in the cause, essentially, and the effects still remain largely unknown. So the difference that I've seen is that there were a lot more free fall bankruptcies back then. And because of that, a lot more litigation. People recognize that Chapter 11 is very expensive. No one wants to lay off the majority of their workforce. So people are coming into Chapter 11 and bankruptcy situations with a lot more, hand holding. There's a lot more agreement. So we'll see a lot more pre-packs, I think. I think that we've also seen a lot more 363 sales. That's probably just because of the way the bankruptcy world is moving. It gets you in and out of bankruptcy very quickly. It saves money, and it's a great option for both debtors and funds looking to purchase debtors out of bankruptcy. So that's sort of what we're seeing now in the bankruptcy world, the difference between COVID and the recession of 2008.
Jared, you want me to go
Stephen?
next?
Yeah.
So I think this is where I agree with Jamila's take, but I like to add, I think this is a very different, because in 2008, I think it impacted the entire economy. This thing is not impacting the entire economy. I think I say it's the haves and the have-nots. The haves, and I'll say for the Bay Area, the tech companies, they're killing it, and they're doing great. But then you have the have-nots in the retail and the travel industry. They're hurting big time, and the small restaurants and the small mom and pop type service industries. And so I think that's, and then you see the stock market. Go figure the stock market. And I agree that there's a lot of people, not everybody's looking for a deal out there, including the tech companies. I've seen a lot of activity in the last 3 months where the Facebooks, Googles, Apples of the world are looking at opportunities to buy technology from distressed companies and also buy people through acqui-hires.
Yeah. I guess my take on it, to add both Jamil and Stephen's comments, is, in my mind, credit markets are sort of wide open today versus where we were in 2008. Cash is plentiful. There was sort of diminishing confidence in the banking system, which isn't happening this time around. Just think about distressed debt funds alone and the sort of steady increase of fundraising that those funds have been doing over the last 6 months. I think there's 100 new funds and close to $100 billion of new capital that's ready to be deployed in struggling companies. And like Jamila said, I mean, most funds are competing heavily for deals right now, just trying to put money to work. And so there's more available capital than there was in 2008.
Yeah, it's really just a fascinating contrast. Go ahead, Stephen. Sorry.
No, I was just going to add, just to echo that, we took a company, a SaaS provider, out to the marketplace 2 weeks ago, and in like 2 weeks have like 15 different bids on the assets. And I just and they're all, now some were strategics, but half of them were distressed funds looking to, do something with it. So I just echo what Tanner says about the availability of cash out there to buy what people perceive are good deals.
Yeah, and I think part of that also is just because people think we're weathering a storm, right? And in 2008, I don't think we thought, oh, let's just weather the storm, put some more money into these companies and see what happens in 2010. Right now, we're thinking, let's put some money into these companies and possibly get a deal because they're going to be making money in a few years.
That is a wonderful point, Jamila, that I hadn't really thought of before. The idea that the mindset of the marketplace is different because it's a natural disaster response as opposed to a financial crisis, and who knows if the system ever comes back. And of course, you can float somebody for a few months because, then we're going to get to, a brighter future that doesn't involve staying at home all the time. Okay, so I thought the next question, and we'll start here with Stephen, and then we'll go to Jamila and Tanner, is just what have you been seeing over the past few months of the pandemic in the restructuring world? Are there particular industries that you've been working with a lot, or you're aware of a lot going on, trends that you think are noteworthy? What's going on in the world?
Well, I think this might be repeating myself, but I think the industries which have been hit are obviously retail, hospitality, travel, restaurants, healthcare, not a healthcare, but health clubs. I mean, it seems like every health, you see a large health club filing every week. I mean, there was another one filed, I think yesterday in New York or Delaware. But it seems like every week there's a 24-hour fitness or somewhat like it being filed. So I see that. So see a lot of those, and the small mom and pops I haven't seen, which we could talk about the PPP money and kicking the can down the road in a few minutes, but so you don't see that. And then the actual number of filings, like in the Bay Area, are down, which is, I think, just because, again, maybe overall the Bay Area is doing well, but there's kicking, and maybe there was just kicking the can down the road, and people are doing, trying to give a lot of concessions and just hoping either banks, landlords, whoever are trying to weather the storm, because if they push them into Chapter 7, they're not going to get anything. So that's what I'm seeing right now.
I've spent the last, I would probably say 10 years of my career focused in some part on retail bankruptcies, and retail has been distressed for the last 10 years. Most people call it the Amazon effect. What that really means is that there was a change in, consumer behavior and consumer expectations. Consumers said, oh, I saw something today, I want to have that in my house tomorrow. And that's something Amazon can do. Fast fashion brands, the Zaras, the H&Ms of the world can do that, but other apparel companies were not set up to do that. They were more, you see it, in September, and you might have it in your closet by May to be able to wear in July or something like that. So retail was really hurt by COVID, but it wasn't just the shutdowns. Obviously, the shutdowns made it so that it was impossible for people to walk around and see. No one was going into malls, no one was window shopping and then jumping in and buying a pair of jeans or a shirt. That is where a lot of sales come from in apparel. But frankly, no one is getting dressed for work, right? Brooks Brothers just went into bankruptcy, and sort of the reason for it was quite obvious. And hilariously, the general counsel of Brooks Brothers just spoke maybe a few weeks ago about now they're focusing on selling what they call Zoom shirts, because otherwise everyone's wearing sweatpants and no one's wearing suits anymore. So obviously retail will continue to be hurt by changing consumer behaviors. They'll continue to be hurt if there's more work from home. If work from home continues in any way, retail is going to be hurt by that. In addition, though, we were seeing some interesting things come out of the retail cases. One of the things that we saw was called the mothball motion. And essentially, this allowed them, in bankruptcy, typically you have to pay all of your debts as they come due. They're called administrative expenses. And the expectation is that as you get those invoices, you have to pay those. And if you don't, there are a number of things that can happen. Your case can be dismissed. A trustee can be appointed, an examiner can be appointed, et cetera. We were seeing courts for sort of the first time ever approving motions that allowed companies not to pay their leases, which was really significant. I mean, it was difficult for landlords, and they fought it in some of the cases. In other cases, they said, okay, pay in this way and don't pay in that way. We saw this in Pier 1. I think it also happened in J. Crew. It happened in Modell's. But essentially, the judge said, we understand this is a difficult time for you. We're going to give you 60, 90 days to not have to pay your administrative expenses. And that was really unprecedented in bankruptcy cases.
Yeah, I guess to add on to both their comments, I think as a restructuring community, we're just seeing less activity than we thought we'd see at this point. I think lenders across the board have been a bit more lenient than everyone thought at the beginning of the pandemic. I mean, Stephen mentioned kicking the can. That's absolutely happening. Lenders want to arrive at a bit more certainty before making any sort of drastic decisions on a restructuring. The availability of capital and government loans and government stepping in has given companies more runway than people originally thought. That being said, a lot of companies that were highly leveraged, that had highly leveraged balance sheets, pre-pandemic, in many cases just added more debt to their books, without enhancing any sort of financial or operational picture post-pandemic. And there's this added uncertainty around what is the customer demand going to be post-pandemic. If it doesn't come back in full for companies in certain industries or segments like hospitality, travel, retail, it's going to make it a lot harder for companies to service this debt over the next few years.
All right, so this was a wonderful transition to our next topic of conversation, which is in the restructuring world, there's a lot of talk about what people are calling the great forbearance. This idea that, lenders and creditors and investors have reacted to COVID-19 and all of this uncertainty by essentially saying, we don't want to make a decision right now, so we're all going to agree to forbear, right? We will not necessarily exercise our remedies as creditors and push companies into bankruptcy. Or, another version of this is we will provide you with additional capital as a bridge to a future, but the future obviously is very hard to see. So my question for the three of you, and I think we can go, Jamila, Steve, and Tanner on this one is, to what extent do you think the great forbearance is a real thing that you see in your practice? And, where do you think, this is going, this practice of, creditors just bargaining for the ability to force companies into bankruptcy or restructuring situations and then choosing not to use them for whatever reason?
Yeah, sure. So I think that the great forbearance sort of came from, again, that initial sense of panic and the uncertainty we continue to have with respect to the COVID pandemic. We don't know, when it'll be over. We're not really sure. We're getting great news about vaccines. We're not really sure when they'll be widely available. And even then, what will consumer behavior look like after there's a vaccine? So I think that at the beginning of the pandemic, frankly, businesses were doing everything they can to make sure that they didn't have to file for Chapter 7. So there was a lot more borrowing. There were a lot of forbearances, and the creditors, especially senior lenders, I don't think wanted to be in a situation where every single one of their credits were filing within a few months' time because of this. So they gave them a lot more leeway. I mean, also interest rates continue to be low. We're still in an environment where everyone thinks that this is going to be a short, something that only happens over a short period of time. So I think it makes sense that there's a lot of forbearance where we've seen a lot of those, and where we think it might be going that we're concerned about is that some of the forbearances have propped up what we've been calling zombie companies. So it's a company that probably should have filed already. They probably frankly should have filed before the pandemic. And they're getting sort of the benefit of that extra cash in the marketplace. And they're continuing kind of to just run on fumes for a long period of time. And eventually there's going to have to be a reckoning with those companies.
Yeah, I'll just jump in here. I agree with Jamila here. I think when we think about the great forbearance, I think the number of defaults when we look at year-to-date 2020 versus 2008, 2009, I think we're up by over 25% compared to those years. But the bankruptcy filings have been half of what they were in 2009. And so companies are defaulting, they're just not getting pushed into bankruptcy.
So I agree with that. And I think every landlord is, I have a 400 store chain that we've been working with, and they've got 30 different landlords. They were able to go out. Well, one, they got a PPP loan, which extended up 3-4 months. And I don't know if that extension was, if they're a zombie company or not, but I question on that. But then they went to their landlords, and every one of their landlords gave them some type of concession. A lot of it was like no rent for 6 months, but you added on the back end. And the landlords, I assume, are just hoping that they'll survive. And with this announcement yesterday by Pfizer, I imagine, at least for the next 3 to 4 months, until we sort of how that works out, you may see some, I imagine there'll be more kicking the can down the road, just because people are hoping that the vaccines will actually work and we'll come out of this thing in maybe 6 to 7 months.
So I think that's an important point that we want to emphasize and make sure you take from this panel discussion, which is there's been this disconnection between the traditional relationship between the default rate and the bankruptcy rate, where, as Jamila helpfully suggested, there really is this natural disaster type mindset where, all we need to do is repair the windows and we'll be ready for the next hurricane. So let's focus on doing that, not necessarily changing things. But there is this problem of there were a lot of companies that were in really bad shape for a long time. And as Tanner has pointed out, a lot of companies are not having discussions about operational improvements. They're talking about, the hurricane and how do you weather it. And so I'm going to turn in a minute or so to taking some of the questions that have been queuing up. But something else that I thought it would be, useful to talk about is just as you're all restructuring professionals. One of you apparently is in the Tucson office of Dorsey and Whitney, but in New York and San Francisco on both coasts. How is your day-to-day life today different because of this pandemic? How has the restructuring world kind of adapted to this new work from home, planet that we find ourselves stuck on? And Tanner, why don't we start with you and then Stephen and Jamila?
Thanks, Jared. Yeah, I think you alluded to it at the beginning of the call. I mean, we're, as restructuring advisors or turnaround advisors, generally on the ground with our clients, helping them through a time of crisis. And so, you think about sort of on the ground problem solving, personal connections with, leaders within the organization. That stuff is happening virtually. It's different than what it was, the way it was happening previously. I think when I think about the sort of the future of remote working, I agree with you. I think it was the Professor Jerry had said, some roles and responsibilities within an organization can absolutely work remotely, especially if their tasks don't change on a daily basis. But when you think about leaders of wholesale change within organizations, people in strategy and growth roles, that stuff's difficult to do virtually or remotely. And so I see people coming back to the office, especially in those types of roles. And there will be more flexibility in sort of where we work, but I think there will still remain this sort of community, in-person community that needs to occur, especially in successful organizations that they're working towards, again, wholesale change.
So I think it's been strange, even though I'm in Tucson normally 50% of the time, I travel a lot, and all my friends who are in the restructuring world travel, and I'm sure Tanner and Jamila do that. So traveling is like almost non-existent. I've been on a plane 4 or 5 times, but I'm like the exception. I have friends who are the restructuring professionals, and they just say, nope, I'm not traveling until middle of 2021. And I say, let's get together. And your comment, Jared, about being at a conference, I think I was supposed to be at 3 or 4 conferences this year that all were canceled. And those are the times where you can maintain and develop the relationships with other professionals in the restructuring world. And I always say that the biggest thing that you have in your skill set is trust with your when you're working with other professionals. And that's one of the things that it's tough to maintain. So a lot more phone calls, a lot of Zoom calls, which I'm not a really big fan of. But with clients, everybody's working remote. And so me being in Tucson really doesn't matter. I was on a Zoom call yesterday in the Western District of Wisconsin, and everybody was, nobody was in court. And I don't know where the judge was. I don't know if he was in his chambers, but we had people from all across the country there. So that makes it a little bit interesting that we're not getting on planes and traveling to courts. And I'm actually amazed how the courts have been able to adapt, and really they're moving forward, and they're servicing professionals in the restored community.
Yeah, Same is true for me. I travel in a normal time almost once a week. So I'm either on a plane going to Wilmington for a hearing or sorry, a train going to Wilmington for a hearing, or on a plane going to see my clients. I haven't been on a plane since March. I also haven't been on a train since March. So that's very different, but it's interesting to not go to the hearings and have everything done via Zoom. But what I've also realized is it's the same is true for depositions, right? So we haven't had to try to figure out where witnesses are and trying to find convenient locations to go for depositions, because everything is just simply on Zoom. I mean, the most I've traveled is downstairs to my kitchen counter where I work every day, I think. And then other than that, I think that because everything is remote, and in some ways it's made things easier, in other ways it's made things more difficult. I think that our evidentiary hearings were initially a little bit more difficult, trying to coordinate witnesses and making sure that everything is sort of perfect with the technology prior to the hearing has been very difficult. But now that we're sort of in the swing of things and the judges and all of counsel's coordinated, things have been a lot easier.
Yeah, my last point, I just think the speed of communications and the ability to problem solve on the fly by stopping into somebody's office and having a 2-minute conversation rather than setting up a 30-minute virtual meeting, that's gone for the time being. And that's made work inefficient in a lot of situations. And so, especially for, companies in crisis.
Yeah. So Jamila and Stephen, just a question to make, it came out a little bit in your answers, but I want to make sure that we hit on it. So the bankruptcy courts are all online. From your perspective, like as lawyers who are used to going into a normal courtroom, is that generally working well? Are you able to get through things as well as you could if you were all in person? And Jamila, why don't we start with you and then Stephen can add.
Sure. So I think I will say it has worked well because everyone has been willing to try to make it work. And we know the judges. So in Delaware, it has been sort of very easy to see, Judge Owens, because I was already working on a case with her. So things sort of lasted or went through in a way that was a little bit more manageable. And she switched around her court rules quite a bit in order to make things go a little bit easier when they went virtually. But I don't know how it would be if I was in front of another judge that I had never had an experience with. I think that would be a little bit daunting.
So I think that overall, well, I always laughed at people who made telephone appearances on a contested hearing, because you don't get to see the judge's looks when they're, and so we don't, a lot of times you don't have the same interpersonal, and you're not getting the feelings of how they're just maybe rolling their eyes, especially if there are just telephonic conferences. So I think that's one of the things that I miss. And also, I also miss that there's so much stuff that's, especially in bankruptcy, a lot of things are accomplished right outside the courtroom. And we don't get that anymore. And that's, that's where you maintain it's like going to conferences. You go to a hearing and maybe you have 20 lawyers there, and that's where you hook up and you resolve things. So I think that's what I miss, but I think overall the judges' roles and the clerks' roles, I think that they're managing the process quite well, and I'm actually impressed. And I echo, I think improved over the last, it started off rough, but it's definitely improved every month. It seemed to be getting better.
Yeah, and I'll turn to the questions from the audience in a second, but I just want to emphasize what an incredible sort of IT revolution that has happened in the courts. It's like 20 years of change in the space of 3 months, where judges who once upon a time could barely, turn their computers on, and now all of a sudden, hosting massive Zoom conferences, like they figured out how to make it work. Judge Jones, who sits in Texas, told me that from his perspective, it's not not just these big corporate cases, the ones that are the topics of the panel that are going to be altered by technology in the future. For consumer debtors, it's really a wonderful innovation, because instead of having to force a consumer to like take a day off of work to come into court, you can have that person go to the car in the parking lot and video chat with them, and he thought you could accomplish about the same thing. So there's a lot of exciting possibility here once we move away from kind of crisis management to embracing these shifts in the way that we all live and work, and how it can, maybe make the bankruptcy system better for at least consumers, and probably, corporate bankruptcies work better as well. Okay, so some questions from the audience that are interesting, and we have some great questions. The first one is, how are bankruptcy considerations and bargaining being affected by the likelihood of a vaccine rollout in the next few months? Are creditors becoming more lenient? And why don't we go Tanner, Jamila, Stephen on this one?
Yeah, I think the kicking the can will continue. I think sort of the restructuring activity will remain the same, and then until we have some view into post-pandemic consumer demand, I think there will continue to be this appetite to kick the can.
Yeah, I would agree. I would say that creditors are already pretty lenient.
Yeah.
And good news on a pandemic or on a vaccine being rolled out in the next few months just means, okay, great, that might signal the end of the pandemic. So we'll just continue to kick it for a new couple of months. I think that if we had received bad news on vaccines recently, that they're not very effective, or that other people have had to stop their trials and we think it's going to be another year before we can start them again, and that would have maybe changed things.
I agree. I think there's going to be a hope. I'll just let's say a restaurant down the street, or just some company, a retail store might have little value right now, but in 3 months, and they're way underwater, in 3 months or 4 months, they'll have money, or they'll be on the upswing. So they may be able to get more value for the creditors in going down the road. So I just think that, but he's lenient. And then the state court, in the state courts, they don't want any collection lawsuits. So there's a reluctance for creditors to take action against distressed companies at this moment. That may change, but I see little appetite for creditors to go after companies at this point.
It's very funny there. When this first happened, a lot of people thought that we'd all kind of become amateur epidemiologists, where those of us who don't do this for a living find ourselves looking at case numbers every day and trying to speculate about where the world is headed. I kind of wonder to what extent restructuring professionals are now consuming vaccine reports in the press and trying to decide, well, how does this impact my 13-week cash flow projection, and where will the world be? And it all just goes to this enormous amount of uncertainty we're dealing with, which is really greater than anything that we've seen before. And so another question that I have, and so this is a question that an audience member directed at Tanner mostly, and I'm going to open it up to the rest of the panel and expand it a bit. And the question is, what is your sense from working with your clients about how much or how PPP loans have helped businesses avoid bankruptcy? And I'd also love to hear, from Jamila and then Stephen, what about the other, sort of congressional or Fed responses to what's going on? So Tanner, you've got a fan out there. What's going on with PPP loans?
Yeah, I work with companies mostly in the middle market, and that was sort of the focus area for PPP loans, especially in lower middle market. It was absolutely helpful to extending the runway. And I think the sentiment amongst a lot of my clients is, the fact that some of these are going to be forgivable is something that absolutely has been attractive for the clients that I work with and for. And everyone's waiting to see what the next round looks like, because funds are drying up.
I think from my take, say a lot of businesses. A lot of people being went to probably the wrong, but that's another issue. But I think it extended the way for 4 to 5 months, and
Yep.
and that was probably the idea what the Congress, the administration wanted, and so I think it did do what it was supposed to do, and I'll be curious to see what happens now over the next 6 weeks or 8 weeks, and then into next more. If there's, what are we going to see? Going to be a big package or a small package out of Congress, and when will it come?
Another way to kick the can down the road. It didn't solve problems for a lot of companies. Did extend the cash runway, but if they were struggling coming into the pandemic, if they haven't made changes, which many companies have not, they're going to be struggling on the back end of the pandemic and dealing with a potential demand issue if they're in a disrupted industry or segment.
So I have a question for Tanner and Jamila, just because what do you think just corporate leadership in this time of crisis? I mean, what's your experience? Good, bad, and different?
Mixed bag, I would say. Mostly good. I think that people who have been looking at this as like a crisis and a traumatic experience of everyone and getting everyone to calm down and sort of go business as usual has been good. But I found something interesting that we talked about earlier, which was, I think Tanner may have said it, that corporate leaders who are not, interacting with their leadership teams are having a difficult time making strategy right now. And so there are people who've been very good at keeping everyone calm and making sure that the company is still creating widgets on a daily basis. But it'll sort of be interesting to see how they then change their business strategy or their operational strategies going forward, and if they're successful at that as well.
Yeah, there's a real need. I think I'd mentioned it before, just sort of accelerate your cadence on planning processes and communication. Things are changing on a daily basis. We were helping clients over the last few months, like, where do you prioritize your efforts or areas of focus? What should I be focusing on? Is it a particular customer segment? Is there one of those segments where the demand is the strongest? Are there internal initiatives that we should just mothball, and other initiatives that we really need to focus on, like pricing strategy, or focus on one core product that we know is going to do well in the pandemic? Or should we just mothball products that are in production? Where are we going to operate? Are there geographic locations that we feel like are going to be more pandemic resistant than others? And this is all sort of happening real time. And where you end up operating, like, what needs to change in those locations? You've got a safety and well-being consideration set that you have to sort of incorporate. What does your customer engagement look like now in sort of the world of pandemic, and those scenarios? You're also dealing with, how long is this pandemic going to last? How can my vendors, where I source a particular key ingredient to something I'm making, are they going to be around in the next 3 months? And do I need to start focusing on a different vendor? Like, what could cause significant disruption to my business? And that is a long list. And so being able to think through all those issues, put them down on paper, talk to your leadership within your organization, and come up with where I should focus is, those are the successful management teams out there.
So another question that's out there for us, and this is something we should really talk about to the best that we can, it isn't core, I think, to any of your practices, is what about municipal bankruptcy? What's the risk of municipal bankruptcy, and what should we look at in thinking about where the future of municipalities are going to be? If there's one type of business out there that has had dislocations in their cash flow and limited ability to manage that, it's really municipalities who have, locked in most of their fixed costs, and in many cases now have increased demands for certain services, but the tax revenue, picture is shifted. And so why don't Stephen, Jamila, Tanner, let's take it. What do we know about municipalities?
Well, I'll just look at the Bay Area. I looked at some numbers. I think when I looked at San Francisco is going to lose 250 million, what they expect on year. They maybe lose another 100 million in sales tax revenues. That's what they're going to, if they're losing on the tax. But it's got to hurt. Anybody who loses that much money. Now, may have reasons. I don't know. I haven't looked into it. But that's just San Francisco. I look down the peninsula. I look, you look at Mountain View or Sunnyvale or San Jose with all their hotels. And I could tell you from firsthand knowledge that their hotel revenues are just like that all along the peninsula. And so they, like you said, that they have fixed costs, and it's got to hurt. And talking about kicking the can down the road, a lot of these municipalities have been kicking the can down the road on pensions, and I suspect that you may see something if this continues going on for another 6 months, that you'll see some municipalities think about doing Chapter 9. And I also think some they fall under Chapter 9, hospitals, small local hospitals may be at risk also because of the loss. Both my wives my wife and my daughter are both medical professionals, and my daughter works for Mayo, and Mayo's they lost $1 billion in the first 4 months. They those type of entities like Stanford or UCSF, they'll make it. But it's the small ones. I think you'll see some, especially if we have another significant spike, and the hospitals have more COVID patients. I think you'll see some hospitals. You're already seeing some care homes, a lot of care care facilities filing bankruptcy across the country. So that's what I see in the next 6 to 7 months, that there will be some significant pressure. I also see possibly colleges. If colleges start, kids don't go back to school in the semester, you already see significant haircuts or cuts in athletics in every university. So that'll be interesting too, to see what happens.
Yeah, I agree especially about the part of kicking the can on pensions for quite some time. If you look a little bit further east to municipalities, there are many that are not doing well. The entire state of Rhode Island, for example, that's one of the reasons why at the very beginning of the pandemic, they frankly said New Yorkers cannot come to Rhode Island. We can't afford to have a massive outbreak here. We just can't. So I think that because the market is not the same for municipalities as it is for private businesses and public businesses, I think that we will see some Chapter 9s coming unless there is, a government intervention with respect to that.
I agree with both what Stephen and Jamila said. I think, some municipalities are going to have to make some tough decisions over the next 6 to 12 months to balance their budget in the new reality. But I'm not sure there's going to be a wave. I imagine that there is going to be some level of government assistance, but we'll see.
All right, so it is almost time for us to go, and thank you to the audience for being fantastic and asking great questions, and to Jerry and his team for putting all this together. But last question, prediction time. A panel like this, we have to end with a prediction. So in 1 or 2 minutes, where do you see the world going? And why don't we start with Tanner, Jamila, and then close with Stephen. What do you think the restructuring world looks like a year from now?
Yeah, I think, like I mentioned earlier on the panel, it's you know, in a lot of instances we're adding debt to already, in some cases, over levered companies, and so that has to be fixed at some point in time, especially if an industry or segment is impacted in any way by consumer demand. I think, again, hospitality, travel, commercial real estate, we're going to continue to see activity in those segments. And who knows, this could be 6 months from now when, the vaccine is widely available and we now see what consumers are doing on a day-to-day basis. And that doesn't really comport with what we thought they were doing when we kicked the can down the road 6 months ago. That's when we're going to start seeing some more activity.
Yeah, so hopefully in a year we have the benefit of, being able to a foresight. Hopefully we have more information on, the pandemic and what a vaccine rollout will look like. And I mean, frankly, if you look at what we've been able to accomplish over the last, say, 7 months, which is information on the pandemic, the rates of people surviving have gotten much better. So in a year, I think that I'm hopeful that we'll be completely out of the pandemic, but at least if we're not, we'll have a lot more scientific information there. And so with respect to that, I think we'll be able to make better business decisions, stop holding off on things, stop sort of kicking the can down the road. If you see a lot of what we thought were previously healthy companies that may have been in the hospitality space, for example, Airbnb, but were not necessarily strongly affected by COVID, took out large amounts of debt at the beginning of the pandemic. So I think we will see a lot of refinancings with respect to that debt for healthy companies. Hopefully some of these zombie companies, we start to see them having the conversations that they need to have and going into either a wind down process or a Chapter 11 process. But I'm hopeful, and I think that we'll have a lot more foresight in a year.
So my prediction is over the next 3 to 9 months, we'll see distressed real estate, especially in city centers. I think that they're long-term, and listening to Jerry in his panel, I agree long-term it'll come back, but at least in the short term, I think there's going to be a lot of pressure and it's going to impact, it won't be a tidal wave, but I think there will be a number of distressed real estate because companies, landlords, whoever, won't be able to weather the storm, and I think you'll see this whole pandemic has sort of had firms, especially in law and restructuring, consider they don't need the 50,000 square foot office space or the 100,000. They can get by with half the space. So I think there'll be a decrease in demand in full space in the major cities, New York, San Francisco, Los Angeles, Chicago, and I think that will impact the market.
Well, thank you so much to our panelists for this wonderful discussion. I hope everybody is feeling very educated on restructuring. And again, thank you to Jerry for everything. And Jerry, I turn this back over to you and your team to send us off.
Thank you, Jared. And let me join Jared in thanking all of our speakers for the day. I'll have to make my last forecast as well. I agree with Stephen on certain properties in the city center, but also on some retail properties in the suburbs, particularly those that have been easy to substitute away with online shopping, so malls and the like. So in the near term, we will see that. And my other forecast is that a year from now, we will be in San Francisco at UC Hastings College of Law on a sunny day. So let's wrap this up with another thank you to our sponsors. Again, we would not be able to bring these programs to you without our sponsors. Our principal sponsor, RSM, our platinum sponsor, University Credit Union, our gold sponsor, United Airlines, and our silver sponsors, California Bank and Trust, VACO, Warland Investments, Kenneth Broad, and Chip Robertson. Many thanks to all of them. And so with that, we will see you all next year. If you want to hear our first post-election forecast, that's coming up on the 9th of December in the morning. That will also be that'll also be on Zoom. And we're going to be talking about climate change and how that's changing business in California as well. So thanks to everyone. See you next year, and stay safe.
Thank you, everyone.